Hello, Rich Owens here. Welcome to another segment, and this one is currency exchange rates. So it's part of this big international reading, but we're going to finally get into some numbers. If you've watched a lot of the other segments in economics, you'll know it's very factual, very discussional, but this now is actually a little set of numbers. So the average candidate hates economics, gets very, very bored with all of the narrative, and just focuses in on calcs. There won't be many, but this is one small area where they exist in econ. So my advice to keep pace with the average candidate, make sure you can do these. So here we go. Foreign exchange quotation. This is the format of the quote that you will see in the CFA examination. This is not our format. We've not chosen this. We are following along from the syllabus. So whether you're used to this quotation or not, whether you agree with it or not, this is how it's going to look. We've got here 1.416 USD/euro. In the underlying readings and therefore in the exam, the way you must interpret that, whether you see it like this on your trading platform or not, is that the euro is the base. So, as it says on the right-hand side, this is the way you interpret. It's 1.416 USD per euro. USD is the price currency. That's the number. There are 1.416 units of the price currency. Per euro, there is 1 unit of the base currency. So it's 1.416 USD per 1 euro. Now, if that's familiar to you, great. If it isn't, you need to get used to that. Two types of exchange quotes you may be asked about in the exam: nominal and real. The nominal is the exchange rate quoted at any point in time. So the nominal exists. You can almost think of the word nominal as being silent. So if I just say to you, oh, I've just seen the exchange rate on my screen, it is 1.416, that is the nominal rate. The real exchange rate, well, we've seen this in the past, nominal versus real. The difference, inflation. So if you take the actual exchange rate, which is quoted, and you rip out the effect of inflation, you are left with the real exchange rate. When you take out the effect of inflation, you take out the price levels, what you're looking at there is really purchasing power. Now, will you be asked to calculate it? Potentially. We have the formula in the readings. If you want to get to the real exchange rate, and we're writing it here as priced/base following this convention, I think it's easiest to learn all of Forex by thinking in terms of priced and base. If you start to think of domestic and foreign, it can get confusing because it depends where you're based. You know, a domestic per foreign is different depending on which country you live in. So I'd always stick with labeling it in your head price per base. Then the base is always the second one. So if we're looking for real price per base, you take the nominal exchange rate and you multiply it by the ratio of the two countries' CPIs. But you put the base on the top and the price on the bottom. So take the nominal multiplied by CPI of the base on the top, CPI of the priced on the bottom. Let's see if we can put that into practice. As I say, I think numbers are possible on this. I'm not saying probable. Most of this exam will be either a discussion, a definition, or analysis of given numbers. Straight calcs aren't that common, but you need to be prepped for it because the average candidate will be in economics. So what do we have? Base period. CPIs in the US and the UK are both 100. Well, here's some interpretation, some analysis straight away. If the CPIs are both 100, then the nominal exchange rate is equal to the real. We are told at that base period, the exchange rate is USD/GBP 170. Get into good habits. Whenever I'm given an exchange rate, I'm going to label the base. So USD/GBP, GBP is the base. It's 1.7. That means 1.7 USD per GBP. Now, that's just given us the exchange rate. That means it's the nominal. But if our CPIs are also equal, it's also the real. Real is equal to nominal at 170. 3 years later, exchange rate is USD per GBP 160. That means the nominal exchange rate is 160. But now, CPI is 110 in the US, 112 in the UK. Again, I'm going to label. GBP is the base. Here's the UK. So that 112 is the base CPI. And as we noted, when we're trying to go from nominal back to real, we need the base CPI on the top. So what is the real exchange rate? Well, let's have a look-see. Real exchange rate, you're going to take our nominal rate. So we were given the nominal, multiply by the CPI of the base on the top. That was the UK of 112, divided by the CPI of the priced US. That gives us 1.629. And that's it. In terms of a straightforward calculation, that's all it is. But have sympathy with the examiner. This is why the exam's going to be more analytical than just straight calcs. You're probably looking at that and thinking, so what? And that's really what the examiner thinks. I don't want to give you a calculation and say just do it, because it doesn't prove anything. What you want to be able to do is chat about it. So what does this real exchange rate tell us? Well, it means US goods and services, so US goods, think of a basket of US goods, that would have cost 170 at the base period because that was the real rate at the base period. It was the nominal, but CPIs were equal, so it was also the real. So US goods and services that cost 170 at the base period now only cost 1629 in real terms, if purchased in the UK. So you're looking at the cost of US goods and services to a UK investor in real terms. Was 170, is now 1629. The real exchange rate, therefore, has fallen from 170 to 1629. Not the most important calculation, not even the most likely calculation by any means, but worth, I think, having a look at. As long as you know that formula, the ratio of CPIs times the nominal, you're in business. And the base CPI is on the top. Next up, spots and forwards. We're going to talk about what a spot and a forward is, and then we'll move into doing cross rates and the like and talk a little bit more about forwards in another segment. But what's a spot rate? It's an exchange rate for immediate delivery. Forward, an agreement to buy or sell a specific amount of a currency at a future date at a quoted rate. So just be certain in your mind here about the timings and what's going on. So today, if we decide to go for a spot rate, we are swapping currency, and we'll swap at that rate. But if we sign up today to a forward contract, nobody exchanges the currency today, but we have committed, we have agreed, we have signed up to transact in the future at a rate agreed today. Key point, you know what today's forward rate is. So you could turn on your screen today and you could look for the 90-day forward rate. That 90-day forward rate is a rate you could lock in, sign up to, agree to today. But you would then go about your life for 90 days and in 90 days' time come back and transact at that rate. You're locking in a rate today for a transaction in the future. Much more on forwards if you look at the derivatives material. Now, market participants. Who's in the Forex market? Hedgers and speculators. Again, big overlap here to the world of derivatives. Hedgers have an existing risk that they want to try and eliminate with forward contracts. So, good example. Let's imagine I've got some foreign currency that I'm due to receive in 90 days' time. So I'm in the US. Somebody is going to pay me euros in 90 days' time. Well, the risk I'm exposed to is that I don't know what those euros will be worth in US dollars in 90 days. So I'm going to receive 3 million euros, which is a huge amount for me, and I have no idea what that's going to turn into in US dollars. My worry is the euro collapses in the next 90 days, and the bag of euros I get is worth nothing in US dollars. So what I do is agree a rate today. I don't want those euros in 90 days, I want USD. So right here, right now, today, I sign up to a forward contract. to sell those euros at a set USD rate. Now I'm locked in. Now I know exactly what those 3 million euros will be worth in US dollars to me in 90 days, and I can relax. Now, whether it turns out to have been a good decision or not, who knows? Maybe in 90 days, those euros would have been worth a lot more. But maybe they would have been worth a lot less. I'm just cutting out risk. Speculators have no existing risk. Your speculators are taking on risk with the forward, trying to earn a profit. They want to lock in this rate, thinking they know better than the market. So they think they can buy or sell a currency at a much better rate than the spot rate in 90 days. So hedgers trying to remove risk, speculators taking on that risk. Sell side, buy side, not too exciting. The sell side are the market makers, large multinational banks. Deutsche Bank historically has had a huge part of the Forex market. The buy side, everybody else. Corporations, investors, governments, etc., and the retail market, tourism, and so on. So really you just need to know the sell side is setting the market. That's who you're going to. Everybody else on the buy side is using that market. All right, we've got the scene set. Let's now do some calcs. First one we're going to look at is the basic idea of currency appreciation or depreciation. It's very simple in a way, but there is a little bit of danger to this. So, first up, USD/Euro, the first thing you do is label it. You can't do this often enough. Get comfortable with the way the quotes will be presented. USD/Euro means that's how many US dollars I will get per single euro. Euro is the base. Decreases from 142 to 139. That means 1 euro, the base, used to get $1.42. Now, that same single shiny euro buys me only $1.39. My single euro used to turn into $1.42. Now it turns into only $1.39. That means my euro is buying fewer dollars and is therefore depreciated. And we can work out by how much. The USD price of a euro has gone down by, well, 139 over 142 minus 1, basic quant calculation of a holding period return, minus 2.11%. The euro has depreciated relative to the USD by 2.11. It is buying fewer US dollars. Get happy with that logic. Or if you just want to learn the rule, if you are considering the base and the number in the quote goes down, the base has depreciated. Then there are two questions which are probably already forming, or two facts forming in your mind. Number one, if the euro has depreciated, what's happened to the US dollar? Well, it used to cost us $1.42 to buy a euro. Now it only costs $1.39. We can say factually, without exception, if the euro has depreciated in that quote against the USD, then the USD has appreciated against the euro. Fact. But the second part is where the danger comes in. What you can't say is that the US dollar has appreciated relative to the euro by 2.11%. Because in this calculation, we don't have the USD as the base, therefore we are not considering one US dollar. Before you can talk about the percentage appreciation of the USD, you have to swap the quote round. So, to swap round a quote, you need to take the reciprocal. If the USD to euro is 142, the euro to USD is 1 over 142. That's the reciprocal. So 0.7042. And you do the same for the second quote, the 139. Take the reciprocal, 1 over 139. We get 0.7194. So that's the quote with the USD as the base. Now you can do your calculation. Should be clear that this time the base has appreciated. was buying 0.70, now 0.7194. By how much? Same percentage calculation. So ending of beginning minus 1, 2.16%. So that's the danger I mentioned. Make sure before you quote a percentage movement that you have done the calculation with that currency as the base. So, solid calculation, definitely get happy with that. And finally, cross rates. Cross rates, again, solid calculation and a scene setter for level 2. We'll do a lot of this to try and make arbitrage gains at level 2. So, it's a basic bit of math. What have we got here? Following FX rates, we've got Swiss francs per US and New Zealand dollars per US, 2 rates. We are asked for the Swiss to New Zealand cross. Okay, well, obviously this rate here has the Swiss in it. Your second one has the New Zealand dollar in it. But there's a third currency, USDs. We're going to use those 2 rates to cancel out the US dollar and be left with Swiss francs per New Zealand. How do we set it up? Well, step 1, we need the Swiss franc per / New Zealand dollar. So we set it up with Swiss francs on the top and New Zealand on the bottom. So we need Swiss francs per New Zealand. We are going to get there by multiplying together 2 rates. But check you have the right rates. We need Swiss francs on the top. So Swiss francs must be there. And we need New Zealand dollars on the bottom. So New Zealand must be there. If we do that, well, USD there. We've set it up so the US dollars will cancel out. And we are left with Swiss francs over US dollars. Now, the beauty of this example is we were very kind to you. You have the right rates because you have Swiss franc per US, which is exactly what we needed, and New Zealand per US, NZD per US. We need USD per New Zealand dollars. So we've got the right rates, but we need to switch this one around. We needed USD per New Zealand. We've got New Zealand per USD. Do we know how to switch that round? Take the reciprocal. So the math gets fairly straightforward. We know New Zealand to USD is 22529. Just take the reciprocal and you're in business. Now we have the right rate. Multiply that by Swiss to US, these two together, and we've got ourselves the Swiss franc to New Zealand rate. Will you be asked to do that calculation? As I say, I think that is more probable than your real versus nominal. And the average candidate who is bored of reading all of the economic theory will see this as an oasis of numbers and hone in on it. So if I was you, I'd try and get good at this little calculation at the back end of that segment.